This is Debt Free in 30, where every week we take 30 minutes and get practical advice from industry experts about personal finance and living debt-free. Here's your host, Doug Hoyes.
Back at the end of December 2017, Ted Michalos and I recorded our prediction show for 2018, and we predicted that there would be three types of bankruptcies that we would see more commonly in 2018 than we had seen in the past. So here we are getting through the first quarter of 2018. I thought we would revisit those predictions and see whether or not we were accurate or not. And since I'm in Toronto today, I have asked Scott Terrio to sit in and defend Ted's predictions, even though, of course, Ted isn't here to defend them. So there were three types of bankruptcies that we thought would increase in 2018. And I want to get Scott's opinion on each of the three, because Scott's here in Toronto meeting with all sorts of people. In fact, we're recording this podcast early in the morning, and we've got, I think, a dozen appointments in the calendar after today. So we're seeing lots of people. We've got lots of data to draw from. Here are the three types of bankruptcies that we thought would increase in 2018. The first one was that we thought that there would be a lot of people denied for debt consolidation loans and refinances, primarily due to the new mortgage rules. Number two, we thought that people would be dealing with lower home equity, and as a result, in a softer market, they may end up filing more proposals, and we'll explain what we meant by that. And then the third one we talked about was cryptocurrency-related bankruptcies, people who invested in Bitcoin and things like that and ended up getting into trouble. So let's go to the first one. People denied for debt consolidation or refinancing because of the new mortgage rules. So, Scott, I think everyone's quite familiar with what we're talking about. The government changed the rules, making it more difficult to qualify for a mortgage. Back, I think it was 2016, they put in a stress test for people who are getting insured mortgages, meaning they had less than a 20% down payment. Starting January 1st, 2018, those stress tests were extended to people who had more than a 20% down payment. And I'll oversimplify it, but basically you had to qualify at a mortgage interest rate about 2% higher than what you were actually paying. So even though maybe the interest rate was 3%, you had to qualify at 5%. So are you seeing, of the people you meet with, people who are coming in saying, yeah, I thought I would be able to consolidate, but I'm having trouble?
I've had a couple of those. That's pretty infrequent, but to have a couple of those already in 2018, and we're only halfway, not just a start of March here, yeah, not even halfway through March. So we're not even halfway through a third of the first quarter. Mm-hmm. That's a terrible thing to say at 8 o'clock in the morning. Yeah. Everybody can try and figure out what I just said there.
We'll take a sip of coffee.
But yeah,
and
more
continue
coffee.
On. Yep.
So, but to have at least two or three people mentioning that already, people are thinking about this stuff, right? Because if you look at the amount of consumer debt out there, it's $1.71 now for every dollar of income. Record high. There's loads of household debt. And as you know from our data at Hoyes Michalos here, people who have houses tend to have about $25,000 more in consumer debt, so non-mortgage debt, than people who rent. And we can talk about that more too, but that's always to me a big number in terms of increase over other people. So what people have been indicating is the homeowners who we see are saying, well, things like, cast off remarks like, well, I won't be using my home to get out of this mess. And, you maybe not follow that up with any more questions, but I guess it implies that either their equity has shrunken in their homes with the housing price drops, and it depends where they live. Obviously, not every area is the same. But if you have a house that's down 10%, let's say, and I think that's pretty common across the greater GTA, maybe not the core of Toronto with detached 416 isn't going to be affected that much that way. But you've probably dropped a good chunk of money in terms of equity in the last 10 months, right? Because peak was last April or May, say.
Yeah, April, May. And you're right. The market is different. The condo market, again, we're recording this sort of towards the end of the first quarter of 2018. The condo market in Toronto seems still pretty strong. Right. But the detached market, so townhouses, detached homes, seem to have come down more.
Especially in the Outer Rim.
And then, you go to the Outer Rim. I mean, I was in Oshawa recently. The market is certainly down there. Yeah, so the farther away you get from the core, the worse it is.
Yeah.
So,
and one thing I noted this morning when I was thinking about this stuff was I remember seeing a number not too long ago, maybe 3-4 months ago, maybe December, someone saying that if the new rules had been in place in 2017, we would have something like 81,000 people would not have qualified last year under the new rules this year. That's a huge number. Yep. I've mentioned this before, I think, but to me, that's shocking. That's a massive number of people who wouldn't have been able to refinance to pay off their consumer debt.
Yeah, and when you think about it, and you made the key point that people who own homes obviously have a mortgage, but the people who don't own homes don't have, but they also have more unsecured debt than people who don't own homes. Yep. So again, really rough numbers, and you can go to our website at hoys.com and look all this stuff up. But if our typical client has around $50,000 worth of unsecured debt, credit cards, bank loans, payday loans, the guy who owns the house might have $75,000 worth of unsecured debt. Yeah. So, and it's easy to understand why. I buy a house. Well, now I'm going to go and buy furniture. I'm going to do some renovations. That all leads to unsecured debt. So,
and the other thing it does too, Doug, is that it makes you more creditworthy. Mm-hmm. So
because you own a house.
So if lenders are, if you walk into a bank to do a basic transaction and they offer you something, which they do, you're going to be a lot more likely to be approved if you have a house with that equity sitting there or whatever. Even if you don't have a lot of equity, you still are a homeowner. So they don't need too many boxes to tick off to give you another visa or line of credit, do they? And that's part of what happens is it's just more tempting for all parties to have more debt. That the lenders they're wanting to sell you more debt. You're tending to say, yes, okay, I can probably handle this. Whereas if you're a renter, they might not look at you quite the same. And that's part of what happens with that.
Yeah. And a house implies stability because, I own a house, I'm going to be living here for a while. Yes, and so a lender is more likely, permanence is more likely to want to lend to you. So you're right. You own a house, you can borrow more.
Right.
It's kind of, that's just the way it is. So even though I have more debt and more carrying costs, I can actually borrow more money.
Right. And there's a couple of things about this, using your house to fund your other debt too. Some people are maybe not serial refinancers, but they've done it once or twice. I've seen 3 or 4 times over the course of maybe a 5-6 year period.
Every couple of years you go back to the well.
Yeah, they run up their unsecured. They say, okay, well, I'll just throw everything back into a refinance. Well, a lot of those people are not going to be able to do that practice anymore. And so if you take that pool of people, okay, now they have to do something else about their debt because I think people are getting tight enough now that if any kind of event happens, like a recession or something, you're going to have people who can't run to that well anymore, right? And then I think there are probably another larger pool of people who haven't done that typically, but now they're thinking about it because they've got to the point where, as I said, the consumer debt is $1.71 for every dollar of income. Well, that affects everybody, right? So if you are running out of steam and you've maxed out all your other credit vehicles, and now your house, you're not going to refi, you're not going to qualify for the refi. Well, now what do you do, right? So I think there's a larger pool of people who are going to be faced with that decision as well.
Yeah, I totally agree. And so we're talking about 2 different points here. People who are denied for a debt consolidation or a refinance because of the new mortgage rules. And I guess the answer is at this point in time, we are not seeing a wave of those people.
No.
It hasn't happened yet, which kind of makes sense because
it's early.
Yeah, it's early. You change the rules on January 1st. Well, it's not like on January 2nd, everyone's beating down our door.
Yeah, and we're not even into a housing, like the peak housing spring period yet, right? So people aren't forced to, or aren't facing a decision. Do I sell in the spring period and get out and take my money or what, right?
Yeah, it'll be interesting to see what happens April, May, June when we get into that period. And the stats I've seen indicate that in 2018, about 40% of mortgages renew, meaning you got to go back and refinance. Now, of course, some of those are variable rate mortgages, so in effect, they're renewing every month, the interest rate I'm talking about. And then others, if you had a 1 year last year, well, of course, it's coming up for renewal. So every single mortgage didn't come up for renewal today. They're coming up for renewal throughout the year. And I think that will be the interesting indication when a mortgage comes up for renewal. Does the bank say, yep, no problem, we'll just renew it?
Right.
And in most cases, they do. They're if they've already lent you the money.
They don't want you going down the street.
No, and even if house prices have gone down a little bit, it's not like they're going to say, "Oh, we're pulling the mortgage back." It's not going to happen.
It's not like a crash. I mean, they're just everything's leveling off, maybe.
But if interest rates are higher, and remember, the Bank of Canada raised interest rates by a 1/4 point in July, and then again in September, and then I think it was January of this year. So there have been 3 1/4 point increases. Which doesn't sound like a lot, but if your interest rate was 3% and now it's getting close to 4%, That's not 1%. That's 1/3. That's 33%.
And the increase is huge, right?
massive.
Percentage-wise. And then also, it also affects multiple things. It doesn't just affect your variable mortgage. It affects your lines of credit that you have, right? So if you have 2 or 3 lines of credit unsecured plus your mortgage, all of a sudden that 3-time increase of 0.75 is going to affect all of those things. So it isn't just $100 here or $50. It's all of those combined. And so as long as your household can afford another couple of $100 a month, which a lot of them can't.
Yeah.
Because there was a study last year by somebody that said exactly that. It was, a huge number of Canadians couldn't handle a $200 increase in their monthly expenses. Well, there it is.
Well, did your pay go up by $200 this month? Because if it didn't, then you've essentially got a problem. Yeah. So a lot of different factors that are playing into it there. So I guess the answer to the first 2 parts of the question is, as of this point in time, no, we are not seeing it. Now, I will throw in one more data point there, and that is the Hoyes Michalos Homeowners Bankruptcy Index. So this is something we calculate every month, and you can, again, go to Hoyes.com or just go to Google and type in Hoyes Michalos Homeowners Bankruptcy Index. And it is the percentage of our clients who own a home at the time they file a bankruptcy or a consumer proposal. And it is at record lows. It's been bouncing around sort of the 5-6% level for the last few months, meaning essentially none of our clients own a home at the time they file a bankruptcy or consumer proposal. Historically, if you go back to 2011, it was about 1/3 of our clients. And of course, back then,
pretty high.
Yeah, well, they owned a house, but there was very little equity in it.
Right.
And as a result, I'm not going to lose my house if I go bankrupt because it's not worth anything. I didn't have to worry about it. Whereas now, obviously, that's a bit of a different situation because the equity is higher. So maybe you can just, so that everyone knows what I'm talking about here. If you go bankrupt and own a house, what happens?
Okay, so what happens in a bankruptcy is home equity is non-exempt, and this is provincial legislation. So even though the bankruptcy law is federal, every province guides property. So it's a federal law subject to provincial. So I've probably just lost everybody. I'm sorry if I did that. I'm trying to clarify and I'm making it worse, but that's the law. And what it says is in Ontario, you have a $10,000 exemption on home equity. So if you file a bankruptcy, the first $10,000 equity doesn't count, essentially. And if you have $30,000 or $40,000 in equity, the trustee is then interested on behalf of the estate in that difference. And that would be an asset seizable, essentially. Now, we don't seize houses and sell them generally. You could pay for that difference in the equity in your bankruptcy.
Yeah,
but you keep your house is the important item.
Right, and this is a relatively new development over the last few years, and you're right, there are some nuances, and a lot of this has not been tested in court.
Right.
So we won't go into the heavy-duty technical on it. I think if you own a house and you've got a lot of unsecured debt, you should come and talk to us and we'll figure it out.
Right.
You're right.
You have more options than you think.
Exactly. So, I mean, if
bankruptcy might be one of them.
Might
not lose your house, right?
Yeah. I mean, if you've got,
it's not a blanket
$5,000 worth of equity in the house, we are going to say, well, there's no way for us to seize it. And I mean, you talk about exemptions, and yes, that's the good word to describe it. It's different than the way exemptions work for a car, but the concept's basically the same. If you've got $50,000 worth of equity, well, then you've got an issue in a bankruptcy because the trustee is saying, hey, where's our money? So as a result, people with significant equity either decide, okay, I'll just sell the house, we take the money. So if you've got $100,000 worth of credit card debt and $30,000 worth of equity in your house, a lot of people just say, fine, let's just sell the house. Here, the creditors can have the $30,000. I can go bankrupt. I get rid of my $100,000 in debt. It doesn't matter. But the more typical solution is a consumer proposal.
Yeah, by far.
So if I have $30,000 of equity in my house, what kind of consumer proposal am I looking at?
Okay, so if you have $30,000 equity in your house, you're probably looking at it depends how much unsecured debt you have, because you have to satisfy that your pool of creditors. So if you have $100,000 owing in credit cards and lines of credit unsecured, then you've probably got to give them something like 30% is usually what they'll take in a proposal over time. So we'd stretch it over time, keep your payments low, and there's no interest on that, which is nice. You get a lot of traction. So if you had $30,000 equity, you'd probably be looking at offering them $30,000 on the 100 that you owe, realistically, because what you're saying is, okay, you guys want 30%. So on aggregate, you're offering the creditors 30%. based on the 30,000 equity in your house, because that otherwise would have been something you may have given up in a bankruptcy. So we kind of base it on what would a bankruptcy have looked like here. You may have no intention of filing a bankruptcy. That's fine. It's all hypothetical and it's math, but that's how we determine the course of action in the proposal. So it's kind of your starting point. And then we see who are your creditors, and that's based on the experience. Like, we do a lot of proposals, right? So we know exactly, and we track who votes which way. And as long as you get 51% of your creditors to vote yes, your proposal will go ahead. So there's a lot of factors involved, but you keep your house. You know, we don't measure your income like a bankruptcy after you sign, and you're free to pay your proposal out.
Yeah, time. I mean, if we're going to all the people you owe money to, the credit cards, the bank loans, whatever, and saying, look,
CRA.
Yeah, Revenue Canada, payday loans, they're all covered. If we go to them and say, well, look, if you don't take this deal, I got to go bankrupt, then it's a pretty simple math question for them. Okay, if you went bankrupt, what would we get? Well, there's 30,000 of equity in my house. That's what you'd get. Okay, well then I guess if the proposal is better than that 30,000, then they're going to take it.
And the guidance that a trustee gives you is exactly that, right? Like, we say, okay, you present us with your situation. What are all your debts? What do you own, et cetera? We look at all of it. We look at your income, and we very quickly determine, okay, here's what you would look at in a proposal. So now we're offering you all of our experience and our knowledge of the law and how it works and how creditors think. That's I think the most important thing. Like, I met with, I don't know how many people yesterday, 8 or 9 people yesterday. And when you start telling them, here's what happens in a proposal and here's how the creditors think, you really start watching the gears change, right? You've got their full attention now because they've told you your story for a few minutes. Okay, that's great. I'm listening and I'm figuring out as we go. And then my turn, I kind of take over and say, okay, so here's what the deal will look like, right? We tell you how much it will cost and everything. So when you leave, you know exactly where you stand as far as your options. And as I said, that's where the lights really start to click on with people when they see, oh, really, all the creditors vote differently? Well, how so? Well, who do I got? Oh, I've got this one. Or, oh, hey, I've got some creditors who don't want as much in a proposal. Maybe you have all tax debt, which is a whole different ball game sometimes, right? It depends what situation you're in with CRA. But that's where a trustee's experience really kicks in with people, I think.
Yeah, and obviously we're happy to go through that analysis with you. So, because it's not just here's what the dollars are, but here's how we think it will play out. So, I mean, I know you and I met with somebody yesterday who has some tax debt and they haven't filed their taxes for the last 3 years. So we said, well, you know what? Those tax returns have to be filed in order for Revenue Canada to consider your proposal because they have no idea how much you owe. You can't go to them and say, I don't know how much I owe, will you take a deal? So it doesn't matter what the equity in the house is, there are some steps that have to happen first. And you're right, there are other creditors who say, yeah, we're a little easier to work with. Maybe we're willing to take 25 cents on the dollar. There are other people who say, no, in this case, it's got to be 35 cents and we want this special term and whatnot. So, but you're right. I mean, we'll do, a couple hundred proposals this month, and we've been doing that for years and years. So we've got a pretty good track record of what they're looking for.
It's a buildup of experience, right? And so you can give them a pretty darn accurate idea of where they have to be by the time they leave is the point, right?
And that's what we're looking at. So, okay. So in terms of housing and debt consolidation and that, we haven't seen a wave of people yet. Primarily because the new rules and the slightly lower real estate market, the slightly higher interest rates have not filtered through yet to the people we're seeing. Are there any other points you want to make on that particular one?
Well, I'm just wondering what one of my pet subjects, as anybody who's read or listened to me knows, is HELOCs, home equity lines of credit, which have gone crazy in the last few years. Canadians are using their home equity like crazy with these things. So part of it is the ease of use. I mean, there aren't too many places or times in life where you can grab $50,000 if you need it, or if maybe you don't need it, you just want it. That's part of the problem. But I'm wondering what's going to happen with home equity lines of credit, just because of the scale of them in Canada at this point. See, since equity has gone up so much with house prices rising, especially in the cities in the last few years, people have suddenly become, on paper, flush and wealthy. And partly it's an illusion of wealth, because unless you sell your house, you're not cashing in, and house prices can go down, as anybody who's over the age of 40 or 50 would know. So I'm going to be very curious to see what happens with home equity lines of credit and how the banks start dealing with those, because they've been giving them out like candy at Halloween. And I'm wondering if there's going to be, a tightening up of that as people, of course, lose equity, like the person that bought last April, fear of missing out. And they went and they borrowed the down payment, and then they got the mega mortgage. So they're double leveraged, right? They're right to the hilt. And then house prices promptly went down over the next 6-8 months. So essentially, a lot of those people will be underwater by virtue of just a less than a year's period of time. And so they don't have access to HELOC anymore because they're underwater, right? So their house is worth less than, or their mortgage is more than their house is worth. That's what underwater means, right? So in that case, you don't even have access to a HELOC. You're not in the game. So there'll be a number of people who taken out of that picture. And then for the people who do have some equity left, given all the new rules, will the banks start to, look at that and say, well, maybe we should just back off on this?
Yeah, and the way I think about it in my mind, a HELOC is kind of like a tap, a faucet that can be turned up, that can be turned down. And so when you go and get a 5-year mortgage, here's the mortgage, this is what the payments are, it's not going to change for 5 years. Doesn't matter if house prices drop by 50%, your mortgage payment on a fixed mortgage is fixed, it doesn't change. But if you've got a line of credit, whether it's a HELOC, a home equity line of credit secured by your home, or an unsecured one, the bank can change the rules anytime they want.
It's open completely.
It's completely open. It's completely callable. So they could say, you know what? Last month the interest rate was 4%. This month it's 5%.
Yeah, subject to rate changes.
Yeah, and if you don't like it, well, go somewhere else then.
Yeah, and the bigger your HELOC, right? The average HELOC is $70,000. That's how much is taken out. Mm-hmm. The average approved amount is $168,000. So if you've got $70,000 on your HELOC, you've got another almost $100,000 available to you, is what the average number is. That's pretty tempting when you've got consumer debt of $171. So you got $70,000 or $80,000 in credit card debt and line of credit debt. Some people took HELOCs out to pay that off.
Yep.
And so now, is that going to keep happening? Maybe it isn't, right? But that's another source of people being able to service or pay off their debt that may go away, right?
Yeah.
So what else are they going to do?
In the past, I've been able to say, well, you know what, I can put that money on my credit card because if things go bad, doesn't matter. I've got lots of empty room on my HELOC. Well, if the bank lets you know, oh, by the way, we've decided to cap your HELOC at whatever you owe us now, and you don't get another cent, or we'd like to start converting them to fixed loans so you can actually be paying them down, then we've got a problem. And again, we are not seeing this to any great degree yet. It's not like every one of our clients. Yeah, we're just talking here. I mean, it's not like every one of our clients bought a house on May 1st, 2017, right at the very peak.
No.
So, I mean, I know, we sound kind of alarmist in what we're saying, but hey, that's our job. Our job is to warn about what happens when things aren't good.
Yeah, right. And there may be at some point in 2018, depending on how long this stuff takes to shake out. Our point is you may see some of this stuff start to happen,
right.
and that wouldn't have happened in the last 2 or 3 years.
Exactly, and that's all we're doing is warning about it. And who knows? Interest rates may start to turn down again. House prices may keep going up for 10 more years, and everything may be fantastic. My only message to everyone is stress test yourself. What would happen if things changed? If interest rates went up another quarter of a point, half a point, would I be able to afford it? If house prices came down a bit, if I'm going to live in my house for the next 15 years, it doesn't matter. But if there's any chance I might get a job somewhere else, need to sell my house, want to transfer.
Be portable.
Exactly. What kind of risk am I taking on? That's all I'm saying. I'm not saying you shouldn't own a house. I'm not some real estate alarmist. I'm just saying to think.
And sit down and do a budget with yourself. So look at all your expenses in detail, right? So what do we spend right now? What are the last 90 days? What have we spent as a household, right? And you can find that out pretty easily because Canadians, I think, are the largest users of debit on earth. So it's pretty easy to go and find out. Probably 90% of your expenses are online, right?
Yep.
And do that. And then as you said, Doug, then make a worst case scenario as well, right? Like, can we afford to live the way we are living now and then take a bunch of scenarios and figure it out, right? If interest rates go up another full point over the next 12 months, what is going to be affected? So is my unsecured line of credit, that's going to be affected. Yes. The second one's going to be affected. My husband's or my wife's is going to be affected. Our HELOC is going to be affected. Our variable mortgage, like those things are all going to go up.
Our mortgage coming up for renewal. So
another one, yeah.
Yeah, and if the answer is you do that stress test and we're going to be fine. Okay, great. Then don't worry about it. It's all good. So that's all we're saying. Don't be blindsided. And we're not predicting interest rates are going up a full percentage point in the next 12 months. We're not saying that at all. We're not economists. We have no clue. If we did, we'd tell you what the lottery numbers were going to be if we could see the future. All we're saying is look to the future, stress test it, and see. So final point, the third type of bankruptcy that we thought we would see increasing in 2018 is bankruptcies related to Bitcoin or cryptocurrency trading. So, I mean, Bitcoin has bounced around all over the place, and I'm not going to tell you what it's trading for right now because 5 minutes from now it'll be totally different. But, I mean, you go back a number of months and it was, a couple $1,000 a Bitcoin, and then it was 10,000, then it was, up into the 20,000 range, then it was all the way back to under 10,000 and then back over. I mean, bouncing and bouncing. So we know, because we've talked to some people who said, hey, this is the train I want to get on. And if you take the money out of your savings account and put it in savings account and put it in Bitcoin and it goes down, oh, well, I guess you lost some of your money. But if you said, hey, I've got this HELOC, I've got this line of credit that I haven't tapped. This is a sure way to make money. Let's take that money, put it into Bitcoin or Ethereum or one of the other ones, and then it comes down. Then you've got a problem. So have you talked to anyone yet who has raised the issue of Bitcoin, or is it still not a thing in our world?
It's a thing, yeah. I mean, 6 months ago or 8 months ago, no, I wouldn't have talked to a soul. Now it's, I probably someone mentions it once a week, or maybe twice a week, which to me is a lot because, you go from never to like, this is a really new phenomenon for the markets, right? And so I think the other issue is I've never spoken to anybody, or no one's ever mentioned it to me, who's over 30.
Yeah.
That's a big thing.
It's not
right?
it's not the
this
seniors
is a young
who are into
thing,
this.
right? So, if you get a millennial or whatever in your office, then there's a chance they're going to at least mention Bitcoin. And what they'll usually say, Doug, is not so much that they've got Bitcoin, but what if?
Yeah.
Because a lot of what we get asked is what if. The typical one is the what if I win the lottery. I get asked that by all the 4,000 people I've filed ever, right? What if I get an inheritance? What if? Well, what if I decide to buy some Bitcoin? Right. And so then, of course, you go through in a bankruptcy, I guess it would be this, or proposal would be this, or what wouldn't matter, whatever. But the point is people are discussing it. I don't know if we're going to see anybody filing because of it, but if you're leveraging crypto, as you said, you're taking your HELOC to buy 50 grand worth of Bitcoin, you might end up in some trouble because if you look at the Bitcoin chart, it's a roller coaster. Right?
Yeah. And I think the best thing that happened to Bitcoin was the fact that it did have this, serious big correction.
Drop. Yeah.
So
19,000 down to 9 or 8.
Yeah.
At one point.
It was a big drop.
Yeah.
And so at least all the people who were investing in it for 4 months and thought it could never go down saw that it could. Yeah, hopefully that put the brakes on it for a lot of people. And they said, okay, now I do understand this is hugely risky.
Yeah.
I mean, frankly, I have the same comment about the real estate market. If you've been in the Toronto real estate market for the last 5 years, it's always gone up.
Yeah.
If you've been in it, like you said, 30 years ago, then you remember 1989 when things,
90s,
when things came down. Yeah. So I think the answer to the question is yes, we are hearing people tell us about it, but we have not yet had someone come in who said, I bet it all, I lost it, now I got to pay the loan back. That has not yet happened. And I think one of the reasons is it's still new and it's still not really easy to put a lot of money into it. I mean, if you've got $1 million in your savings account, you can walk across the street to your stockbroker, put the $1 million and buy stock. It's not that easy to put $1 million into cryptocurrency.
There's a certain barrier to it. Like there's a certain level of computer sophistication. For one thing, is to you got to get a crypto wallet. Like what is that? I don't even know what that is, Doug. But I know you got to get it, and so that's one step. And then you kind of got to know what you're doing with that, right? It's not like buying and selling stocks on some online brokerage.
Yeah, I mean typically you do it through an exchange, and so you have to fund the exchange. Well, most exchanges are afraid you're some kind of terrorist terrorist or drug dealer. So you've got to verify your identity, send them a picture of your passport. You got to put the money in. You can only do it in certain increments. And so you can't put tons and tons of money immediately. And as a result, I think that puts the brakes on it a bit. You can't get into as much trouble.
Transactionally too, I think it's tough. Like you don't just buy it and sell it. It's you got to.
Well, once the money's at the exchange, it actually is pretty simple to buy and sell. It's getting it in, but yes, getting it out may sometimes be an issue too.
Yeah.
And you're right. You typically don't want to keep it at the exchange because they can get hacked. You don't worry about keeping your money at the bank because it will get hacked because, banks don't get hacked, or if they do, there's protections in place. But a lot of these crypto exchanges have just sprung up over the last number of years. Yes, they do get hacked. So you're right. The experts would tell you when you buy your Bitcoin, you have to download it to your own secure wallet, either on your computer or on a third-party device or something like that.
And some of that stuff alone probably eliminates a lot of it. Like, I'm just, I'm not going to bother.
Yeah, that's just too much. So as a result, you're right. The 40-year-olds, the 60-year-olds, the 80-year-olds aren't coming in here saying, yeah, I bet it all on Bitcoin.
And those people are also at a different stage of their wealth lives,
right.
Aren't they? Right? Like, do I want to risk what I've built here? Like, if you're 50 or 55 and you've built up is Bitcoin for you? Mm-hmm. Like, because you might lose it, right?
Yeah.
So that's a whole different decision for that demographic.
Yeah, and I think what will make cryptocurrencies take off will be, number one, ease of use. Is it easier to use them? And then more applications for them. I give a lot of talks, and every talk I do, I get a senior who comes up to me and says, what should I do with my money? Because, I don't want to be putting it in the stock market because that's risky, and I'm earning like 0% interest. Well, if there was a way to invest in cryptocurrencies and increase your returns, that would become tempting for people. But we're nowhere near there yet. And I still think we will probably see someone this year who, because of cryptocurrency trading, got into trouble, just like we see people every year who got into trouble with, the stock market or whatnot.
I think enough time has passed with it that another 12 months we'll see a handful of people come in and say, hey, I got some Bitcoin issues here. So I think that will happen. I promise to report if I get that.
Yeah, we will. So, I'm certainly hearing reports of people talking about it. We're just not seeing it. So we will, but we will keep an eye on that. And for those of you who listen to this podcast every week, thank you very much. There will be a podcast coming up at some point in the next number of weeks where I'm going to interview a company that has blockchain technology. So it's not Bitcoin. Blockchain is the technology that cryptocurrencies are based on, but they're using it for a very interesting application that has a direct impact on the personal finance world. So you're going to want to listen for that one because it'll be very cool. So hopefully we'll be able to provide some information on that. So excellent. Well, so I guess the answer is we're still early in the year. The sky has not fallen. The world has not changed substantially, but things are bubbling out there. So protect yourself by looking ahead, doing your own stress test, and deciding what you need to do for yourself.
Yeah, there's a lot of consumer debt out there. That's the point, right? Is there's a lot of consumer debt that's been building over the years, and yes, home equity's been building too, but then house prices have leveled off. So I think there's, a potential for something to happen in this year or maybe in the next 18 months. And it's kind of just bubbling, as you said, out there. So nothing yet. It's early, but I think there's probably people are going to be faced with issues at some point.
Yep. And don't listen to any of the experts. Don't listen to what we predict for the future because we don't know. Nobody knows. Predict your own future. Crunch your own numbers. Do your own stress test. That's really what matters. So excellent. Well, thanks very much, Scott. It's still early in the morning. We've got lots of clients waiting, so we're going to get to them. Thank you for doing this. There will be, as always, full show notes and a full transcript at hoyes.com. That's HOYES.com, and we'll put links to what we talked about at the end of last year as well, and put a link to the Hoyes Michalos Homeowners Bankruptcy Index so you can track that. So please check that out. And until next week, thanks for listening. I'm Doug Hoyes with Scott Terrio. That was Debt Free in 30.